It is a pleasure to introduce our next instructor. Rajeev Agrawal is the founder and advisor at DoorDashi Advisors. Rajeev has been investing in the US and Indian equity markets for more than 15 years. Rajeev follows value investing principles and finds that Indian equity market provides wonderful opportunities for his style of investing. Prior to starting DoorDashi, Rajeev was a technology executive focusing on the financial industry. He retired from IHS Markit as managing director and chief technology officer. Prior to that, he worked in the US in various senior positions at Goldman Sachs, Bank of America, JP Morgan, and Dresdner Bank. Rajeev completed his B.Tech from IIT Bombay and MBA from IIM Kolkata. He is also a CFA charter holder. On behalf of the MOI Global membership community, a very warm welcome back to you, Rajeev, to this forum. It's always a pleasure to have you. Please go ahead.
Thanks a lot, John, for that very nice introduction. It is indeed a big pleasure to come back and present at Asian Investing Summit, a wonderful forum to exchange ideas. And congratulations to John and your team for putting this together. Before we jump into the presentation, a quick disclaimer. The content of this presentation is only for the information of the participants and not to be construed as investment advice. Please consult your financial advisor before acting on it. We at DoorDashi Advisors, along with our employees, partners, clients, may have positions mentioned in this presentation. There are a few additional disclaimers here, which I would request participants to look at when they're going through the presentation. So the agenda for today is to give you some background about ourselves as well as DoorDashi, how we invest, as well as how that has translated into some of our returns. And then we will jump in the idea for the day, which is JM Financial. To look at JM Financial, we will look at the different segments that JM Financial is in, look at its valuation, potential risks with this idea, and then finally summarize the thesis. So jumping into the background. So as John mentioned, I started DoorDashi in 2016. I'm also a SEBI registered investment advisor. I have been doing personal investing for 15 plus years. Very happy to inform that I have been ranked as a top 10 analyst in East and South Asia category on SumZero, a platform for professional investors. So there are more than 1,900 analysts which are covering the East and South Asia category, and we have been ranked in the top 10. So very happy with that outcome. Prior to starting DoorDashi, I was managing director in India at IHS Markit for 4 years, and prior to that in US for 12 years, where I worked with Goldman Sachs for 4 years, Bank of America, JP Morgan, and Dresdner Bank. From an educational perspective, I'm a CFA charter holder with MBA from IIM Calcutta and B.Tech from IIT Bombay. Jumping into DoorDashi, our objective at DoorDashi is to seek superior long-term capital appreciation. Now we seek to achieve this objective through our investment approach. We follow value investing, and value investing for us is not just buying cheap stocks, but really buying companies where we think that the forward expected return in those companies are much better. And as we get these better returns, we also have much higher margin of safety, effectively not having risk of losing our money. We tend to concentrate in our best ideas, and our top 10 positions would constitute the bulk of our portfolio. We have a long-term orientation, and that mutes out some of the noise that exists in the market. We have a skin in the game with our investors, where most of our fees is driven by the performance of the portfolio, thus we being in the same shoes as that of our investors. We are sector and market cap agnostic, and so we will go into sectors and into companies which we can understand, sector being no bar. And similarly, market cap is not a bar for us, and we would go where we are finding value and where we think we have a different perception vis-a-vis the market. We seek to find companies where we can trust the management. We can see that the management is doing good capital allocation and being fair to the minority investors. We also want companies and businesses where those businesses will over time deliver value in terms of growth, in terms of continuing to reward shareholders through buybacks, dividends, and so on. Lastly, we want to benefit from the manic depressive behavior of Mr. Market. And what is unique about this particular part from an Indian equity market perspective is that in India, the markets are more volatile and therefore provides more opportunities to benefit from this behavior of Mr. Market. So if I have to summarize the approach we follow at Dudarshi, it will be we go where we have a competitive advantage. So let's look at how this objective and this approach has helped us in terms of our returns so far. So I returned from US at the end of 2012, and we started tracking our portfolio from 2013 September. So from September of 2013 till end of Feb or 1st March 2019, we have delivered a CAGR of 41% returns. Compare that to a BSE 500, which has delivered 15% return, thus giving us an outperformance of almost 26%. These returns have come across various years, 2018 being an interesting year where a lot of fund managers had difficulty, and so did we. Our goal always is to get much better absolute returns, irrespective of how the markets are doing. And definitely 2018 has been a good learning experience from that perspective. However, from an overall perspective, we think we have done well, and we continue to learn more, and forums like this help us with that. The returns that we have mentioned here are in Indian rupees, and they are for the core portfolio. Obviously, these are past returns, and they may not be a good predictor of future performance. Looking at these returns from a graphical perspective, 100 rupees invested at the end of August 2013 has become more than 650 rupees in our portfolio in end of February 2019, thus giving us 6.5 times in the last 5.5 years. And if we compare that to BSE 500, and I've chosen BSE 500 because it is a broad measure. The Nifty 50 or the BSE Sensex are very narrow measures, and we wanted a broad measure because our universe is the entire spectrum of stocks that are available for us to buy and sell. So we think our approach and our returns have been very good, and we are very happy with the performance so far. Now, jumping into the idea that I'm going to present today, and that is JM Financial. So JM Financial is in the financial services industry. As of today, which is 28th of March 2019, it is valued at 94 rupees a share. And in terms of market cap, that's around $1.1 billion. In terms of valuation, the price to book is 1.6 times, and price to earnings is 12.5 times. Promoters, the people who started the company, own 62.1% of the company, and the foreign portfolio investors own 17.4% of the company. Nimesh Kampani, the founder, started the company in 1973, and he is currently the non-executive chairman. Vishal Kampani, his son, is currently the managing director and CEO. The company is rated AA by most of the rating agencies in India, and they have a liquidity of around $1.4 million on a daily basis. Some additional facts: it is listed on National Stock Exchange and Bombay Stock Exchange. It is a pedigreed firm, having had a joint venture with Morgan Stanley in India from 1998 to 2007. It partnered with Vikram Pandit, ex-CEO of Citibank, in 2014 to focus on real estate lending. In 2018, the company raised 650 crores from institutional investors at the price of 162 rupees a share. Do note that the current price is 94 rupees a share, as I mentioned earlier. So the price today is at a significant discount to the money raise they did in February of 2018. To better understand the company, let's look at this business lines slide that GMF had in its 2019 Q3 presentation. They divide the business into 4 segments. The first one is investment banking, wealth management, and securities business. Investment banking is all about underwriting business, both equities and debt, where they are among the dominant player. There is also the institutional securities and institutional brokerage side, as well as the retail brokerage side on the security side. Wealth management is providing advice to the wealthy clients. This constitutes, they have an AUM here of around 40,000 crores. They also have a syndication desk where they downsell the loans that they may originate, as well as a distribution where they distribute third-party products to their clients. They have an alternatives business, which is private equity fund as well as a real estate fund. This is a pretty small portion of the overall business and not a big value creator for now. And lastly, they have balance sheet support, where they look to raise money as in terms of distributing it, as well as treasury operations. For the first 9 months of financial year 19, this segment has contributed 45% of the revenue and 44% of earnings. The second segment is the mortgage lending business. Here they provide lending to the developer, to the real estate developers, as well as mortgages to retail in terms of housing, loan against property, and educational institutional lending. This lending business contributes around 35% of the revenue in the first 9 months and around 30% in terms of PAT. The third business is the distressed credit business. And this is where they buy distressed assets, look at restructuring them, and then ultimately selling them to the right parties and ultimately making money through management fees, through interest fees, as well as the carry that they may have. This business has contributed around 16% of the revenue in the first 9 months and around 18% of earnings. And lastly, they have the asset management / mutual fund business, which contributes around 3% of revenue and around 5% of earnings. Now, when we look at analyzing this particular business, what we have done is we have moved all the lending business into the lending segment. What GMF had done in the previous slide was all the lending that they were doing for the IWS clients, they were keeping it in the IWS segment, right? But we believe that analyzing this company becomes a lot easier if we keep the funding business on the lending side and primarily the fee-based business in the IWS. So that is how we are going to look at this business and analyze this business. There will still be a small segment of lending that is going to sit in IWS, and that will be more on the capital markets lending, which is not a separate entity that they break out. But the bulk of the corporate lending, the capital markets lending, and the retail lending they do through a entity called JM Financial Products, and we will treat that particular business as part of the lending segment for our analysis purposes. So having looked at the business lines, let's look at how the company's business has evolved over the years. So if you look at, we have a few charts here. So the first chart on the right-hand side, top, tells you how the revenue and earnings have grown over time. So from 2010 to 2018, revenue has grown at a CAGR of 23.5%. Earnings has grown at a CAGR of 19.5%. Earnings per share has grown at 17.8%. So earnings per share is slightly lower for 2 reasons. One, they do give out ESOPs to their employees, as well as they had a capital raise in 2018, which diluted the number of shares. Also, the return on equity has improved from 10% to 16% in the last 8 years. Now, if you were to look at how the revenue and the profitability has changed across various segments, what is interesting to note is that lending, which used to be around 30% in 2009, now contributes around 70% of the overall revenue of GM Financial. Thus, clearly, lending has started to dominate the revenues of the business, overall business. In fact, this trend is much more prominent on the profit before tax side, where you can see that almost 80% of the profit before tax is coming from the lending business. That's clearly lending is what is creating a lot of value and a lot of profitability for this particular entity. So we will look at each of these segments and how they have done. So starting with the lending business. If you look at the lending book, it has grown from 2,000 crores in financial year 12 to almost 15,000 crores in financial year 18 and 16,000 in the last quarter of 19. So the book has grown, the loan book has grown at almost 7 to 8 times, and profitability, which is profit before tax, has followed and grown at 6.6 times in the last 6.5 years. The yields and NIM have fallen in the last few years, and this is increasingly because they are looking at getting into better loans with higher collateral, as well as the competition in the NBFC space, where a lot of new players came in, thus pushing the yield down. While the return on equity held up at around 17% in financial year 18, if we look to the quarterly return on equity, which is the second chart, we will see that return on equity has fallen on a quarterly basis for the last few quarters. And the reason for the fall has been that management has taken a very conservative stance during the recent dislocation in the market. Now, for those who are not familiar with the recent dislocation, in September of 2018, one of the big NBFCs, non-banking financial corporation, which is called ILFS, was earlier rated AAA, and then they got degraded to a default. And that actually squeezed liquidity out of the system. And as liquidity went away, a lot of NBFCs suffered, both in terms of raising the money and then also distributing the loans. So GMF decided to be very conservative and let the loan book go down in Q3 versus Q2. So they actually reduced their leverage, and therefore their debt to equity has come down to 2.15, and they have a capital adequacy ratio of 26% in Q3. So they have a very high capital adequacy versus RBI requirement of 15%, and they have a very good asset quality with a gross non-performing asset of 0.7% and a net non-performing asset of 0.6%. So I think the key message is that they have a lot of firepower, they have a lot of capital available, right? They have very good asset quality, and I think they can easily scale up the book very quickly and start bringing profitability and return on equity if they so desire. To better understand the lending business, we will look at it from the eyes of two different entities that drive the bulk of their lending business. One is the JMF Credit Solutions, which is primarily into lending for the real estate developers. And second is JMF Products, which is primarily lending in the capital markets, corporates, SME, as well as any overflow from developer finance that cannot be kept on the books of the credit solutions business. So those are the two businesses that we'll take a deep dive at before, after looking at sort of the overall lending book. So here is the lending book profile. So as you can see, of the 16,000 crore lending book, wholesale mortgage, which is again the lending to the developer community, developers, real estate developers, is 11,000 crores. They have a smaller book to the retail, which is only 450. Capital markets is around 1,600 crores, and corporates is around 3,000 crores. Now, if you look at this book, wholesale mortgage gives them the highest yield, somewhere between 13 to 14%. And capital markets book gives them the lowest yield, somewhere between 10 to 11%. Retail mortgage and corporates will be in the middle. If we look at the NIM over the last quarters as well as year on year, we can see that the yield has continued to be around the 13-ish range, though the net interest margin NIM has come down in the recent quarter. And that is because you can see that the cost of funds have gone up to 9.3%. And this is because of the liquidity situation that I was talking about. As I mentioned, the gross and net non-performing assets have been well contained. The one thing to watch out for is SMA2, where the lending book, where they have interest not paid, which are between 30 to 90 days, has gone up to 1.6%. In terms of the return ratios, return on equity in Q3 was 14.7%, and as I said, the capital adequacy is 26%. Now, one of the things a lot of people have focused on is the asset liability mismatch that NBFCs have. And one of the mismatch has been where companies have been borrowing short-term funds and doing long-term lending. If you look at what JM Financial borrowing profile looks like, they have in December 2018, they have short-term funds, which is 32%, and long-term, which is 68%. Since a lot of their lending is in the capital market space, as well as in the asset reconstruction business, and also for corporate lending, which could be short-term promoter lending, they have been able to explain that why the short-term lending of 32% is creating no mismatch as far as the asset liabilities are concerned. They also have been able to grow their long-term loan book in the last few years. And earlier, the long-term funding side used to be only 15%, and now it is almost 68%. So that is a significant improvement for them. In terms of the rating, as I mentioned, they are having very high ratings both on the long-term as well as the short-term rating of AA stable and A1+. Now, looking at the JM Financial Credit Solutions business, so the loan book here, if I look at it from Q317, which was around 4,000 crores, 2016 was 4,000 crores. It has now 8,000 crores. So it has doubled in the last 2.5 years. And profitability has followed in a similar manner. In this particular business, company raised 875 crores in 2019 Q2, valuing this particular business at 2.7 times price to book on a post-raise basis. The return on equity has come down in this business in the recent quarters, as both because of the competition, company has raised capital as well as reduced their loan book. So there are multiple factors causing the return on equity to come down. The debt to equity is very small at 2.15, and the capital adequacy is at 30.3, thus giving them a long runway in terms of lending without raising any further capital. The asset quality continues to be good, and the numbers I quote here are from the end of financial year 2018. Loan book is secured by cash flow of projects, and this is the best form of security one can have. So 85% of the loan book is very secure, because as the cash comes to these developers, it is automatically escrowed away to GMF CS, and so it makes it easy for them to keep collecting interest and principal. And 73% of the loan book is to residential projects. Now, residential is where there has been stress simply because a lot of the real estate sales have slowed down in the recent quarters. GMFCS is rated AA by various agencies. The second business is the financial products business. Again, loan book here again doubled in the last 2.5 years. And ROE also has come down in the recent quarters, just like the credit solutions business, as it is focusing more on secured book and hence lower NIMs. Once again, they have lowered the loan book, and leverage has come down to 3.9x from 4.4 last year, which is also resulting in lower PAT and return on equity. Now, interestingly here, the corporate loan book of GMFP works closely with the investment bank for originating these loans, and therefore, the loans that they originate are of very high quality. You can see that the asset quality in GMFP is even better than in the GMFCS at very low gross non-performing assets of 0.26. The capital adequacy though is lower, and at some point they will need capital infusion from the parent GMF into this entity. They are also rated AA, and the ownership of GMF in GMFP is 99.35%. So pretty much fully owned by GMF, this particular company. While if we look at GMFCS, that is owned by GMF up to 47.1%, which I'm not listed here, and the rest of the ownership resides with Vikram Pandit and his group. Okay, so moving on to the second segment, apart from lending, that is the asset reconstruction business. So this business was established in 2008. Over time, regulatory changes have enabled ARC to play a crucial role in resolving distressed assets. In fact, they are now at the center of help address the distressed asset issue in the financial system. In the recent past, ARC has taken higher AUM for itself rather than distributing it to other players for two primary reasons. One is that more and more deals are now being done in cash. And so now if you want to buy distressed assets, you have to give out cash, all the money upfront to buy those assets. While earlier they could have given out security receipts. And second is that the ARC is seeing much better opportunities and therefore taking more of those assets for itself. Now, in the ARC, the revenue and profitability varies a lot, definitely on a quarter to quarter, but also even sometimes on a year-on-year basis based on the resolution of assets. We can see that in the charts on the right-hand side, where the earnings sort of dipped in 17, came back in 18, and 19 looks even better. You can also see on the right-hand side that the ARC AUM has grown from around to up to 14,000 crores in the most recent quarter. The portion that ARC is keeping for itself in that is around 3,000 crores of those 14,000 crores. As the IBC resolution, as the insolvency code resolution picks up, we expect that the ARC patch to improve significantly from where it stands in the recent years, and that will help drive the profitability of this particular entity. One big asset of the ARC, which is Leela Ventures, has been bought out by Brookfield in 19 Q4, which is the quarter ending March, and we should see good profitability come from that particular sale. ARC also raised 280 crores in financial year 18, and with that capital raise, ownership of GMF has gone up to 57.1%. ARC is rated AA- by various rating agencies. Moving on to the investment banking, wealth management, and securities business. This is the oldest business of the group. In financial year 2019, the GMF changed its reporting so that all lending to IWS clients was included in IWS business. However, as I mentioned earlier, for our purposes, we have kept the lending from GMF financial products to be part of the lending business, and we are not considering that here as part of this reporting. We can see that the revenue in this business varies quite a bit, but more importantly, the profitability varies significantly from year to year based on the sentiment in the capital markets. So you will see that years 12 to 14 were pretty depressed for this business, and then 15 to 18 have been good years. 19 so far looks to be muted. Some of the other businesses that they have are the wealth management business. And in wealth management, the AUM has grown, as you mentioned, from less than 20,000 in 2012 to more than 40,000 in Q3 19. They also have the alternatives business, and that has been less than 1,000 crore at this point. Really not a big business for them. Lastly, they have the brokerage business here, and the brokerage business, the equity market share has continuously come down. However, this is a key part of their overall offering to the client because they want to give to their clients one place solution for all their needs. and so this will continue to be a core part of the business. You will notice that the return on capital, which I show on the top graph, again has a lot of variation based on how the business has done over time. And the last business, the last segment, is the asset management business. So this business was primarily a debt AUM business, where they were primarily managing debt for their investors. But in the last few years, they've increasingly grown the equity business, and now equity is a much bigger portion of the asset under management. This transformation is reflecting in higher revenue as well as higher profitability for the asset management business. The return on capital has also gone up a lot in the last few years, and that is because they have targeted only high net worth individuals as well as corporates for building out the asset management business. Now they're looking to grow the asset management business for the retail investors, and so far they're met with limited success. JM Financial owns 59.5% of the asset management business. So having looked at the various sectors of GMF, now let's look at how we can value them. And since these are different businesses, we will do a sum of the parts valuation on these businesses. So here what I'm going to do is I will value different businesses by different approaches, and maybe in some cases I will value them using multiple approaches. So the first business, which is the credit solutions business, is the easiest to value. And it is the easiest to value because they recently raised money in this business from third-party investors, right? And they raised it at price to book multiple of 2.7x. So that is how we will value it. In Q3, book value was 2,790 crores. So just apply that multiple and keep into account the ownership that GMF has, and we get the value for shareholders is 3,500 crores. For GMF products business, financial products business, we will look at it both price to book and price to earnings. We are getting a slightly lower multiple to this business vis-a-vis the credit solutions because they have a lower ROE. However, we do know that they have much better asset quality. So therefore, we are not reducing the multiple very significantly from where it exists for credit solutions. And just repeating the process and using a price to book of 2.5x, we get a certain value. And we also value this business using price to earnings. Now here we are using 18x and using a trailing 12 months of earnings of 214 crores. Now the reason for 18x is because this is again a high growth business for them. As we saw in the segments analysis, that the lending book has grown at more than 30% in the last 2.5 years. And still they have a long way to go. So we think the earnings can continue to come at a fast pace, and therefore we can apply a higher multiple. On the investment banking, wealth management, and securities business, we apply a multiple of 16x. It is a low capital, it is not a capital intensive business, good capital employed, return on capital employed. However, it is cyclical. And right now, when we look at the trailing 12 months earnings, these are depressed earnings. And so willing to pay a little bit extra, and that comes to, with a 16x multiple, comes to around 1,800 crores. Moving on, if we look at the asset reconstruction business, again, we are valuing it using price to earnings and price to book. Very similar approach, except that here the multiples are slightly lower than we have used, even though we think that ARC business will do quite well over the next few years. The reason for lower multiples is that this business has a lot of variability in earnings based on when the resolution of the assets happen. And so we just want to be a little bit conservative and not give too high a multiple. So you can see the valuation for shareholders around 1,500 crores from an ARC perspective. And lastly, for the mutual fund business, we have used three different approaches. One is the multiple of AUM. So 5% of AUM is how we are valued. And in the asset management business in India, the multiples have been between 5 to 8%. So we are using the lower range of that band, a lower value of that band. And since it is a 74% of AUM is equity, we think it definitely deserves a 5% AUM, of AUM. So we can value through that price to earnings, where it is a pretty high return on capital business. And they also did a buyback in that particular entity in 2018. So we have used the buyback price. And if you were to use that buyback price to value the entity and then come up with the value for shareholders, we get those values. So having gotten these values, what we do is we do an average across multiple approaches, and here we get a value for the overall company, and that's 11,110 crores, effectively 132 rupees a share. So knowing that the current price is 94 rupees a share, while sum of parts valuation is 132 a share, we think there is an upside of 40.6% in the short term. Now, in many of the sum of parts valuation, people talk about holding company discount. There is no holding company discount here because these businesses all go together and they are all helping each other out. This is not about where they are just holding assets and really there should be any discount. Also, it is important to understand that in financial year 18, they raised money from investors at 162 rupees a share. So both our valuation as well as the current price are at a discount to what they raised and what the investors expected in 2018 February. Now, the other part of our thesis is the management, right? And we will look at management from a few different perspectives. One is the board of directors. So they have a very strong board of directors with two promoter directors, which is Nimesh and Vishal, and six independent directors. Nimesh, we have already talked about. Vishal is an MS from London Business School. He has worked across various businesses of the group since 1997 and took over only in 2016. So he has spent a lot of time in the trenches of this business and knows the business very well. The independent directors have been of high repute, and they have been very successful in their chosen field. So we feel pretty good about the names that we see here on the board of directors. In addition, as I mentioned, the shareholders' incentives are aligned with that of the management because promoters own 62% of the company. The management is very conservative. This is reflected through the low leverage, only 2.2x, high capital adequacy, 26%, very good asset quality, especially given the cycle that that we are going through in Indian economy, in the financial space, gross NPA 0.7, net NPA 0.6. In fact, they reduced lending when they saw competition bringing down the coverage ratios, both in terms of cash cover and asset cover. So that shows that they would rather not lend rather than lend where there is not enough safety. We have noticed that they take write-downs quickly and through P&L rather than reserves. So in 2019 Q2, they took a write-down for an investment that they hold in Nitco, and they took that through P&L. Many other companies would have taken it through the reserves and not impact the P&L. Even in past, they have taken write-downs very quickly when they have noticed that asset is not recoverable. Management has an unusually long-term mindset, and that's good for us to see. So a comment from 19 Q2 conference call is we're building this business for decades and not for the next quarter. And it tells you that because of the ownership and because they feel like this is their sort of primary wealth creator, they want to think from a long-term perspective. They have high level of transparency in reporting, and they're very direct even on conference calls. So in 2019 Q2, there was a lot of questions about developer financing. They actually gave the top 10 developers to whom lent in the order in which they have lent. So that gives us a lot of comfort that they are willing to share the information to allay some of the concerns of the investor. Within the Company family, they have a strong next level leadership. Each business segment has a clear leader, and these leaders of these businesses have been in place for many years, which gives continuity to those businesses. There is also an equity culture to align incentive, and employee ownership is around 3 to 4%, primarily through ESOPs. Now, what are the risks with the thesis? The key one is the tight liquidity situation for NBFCs persist. Now, we know that 2018 September, there was this liquidity crisis that I mentioned. We are starting to see signs of these liquidity ease out, and we think that given that RBI has lowered rate the previous MPC, I think they will again be lowering rates. And given that rates are coming down world over, or at least not going up anymore, I think there is a very good chance that the liquidity situation in for NBFCs is starting to improve. The second big concern is lending to real estate developer encounters headwinds. We know that real estate segment has been under pressure because the end consumers are not buying as much of the residential real estate, thus making developers, putting developers in a difficult position to pay the loans to the finance companies like JM Financial. We know also that JM Financial gives out loans with a high level of asset and cash cover. So we think they are well covered. In addition, they were able to raise money in as recently as 6 months back at a 0.7 times book. And that again gives us a lot of comfort that people have looked at the books and have been able to get comfortable that these guys are doing the right things. So we think while this is something which is an observable, this is not as big a concern as it would have otherwise if they had struggled to raise money. The third one is we think the management is very conservative, is decides not to push forward with the opportunities. So we do believe that opportunities are not always there, and to be able to take advantage, one has to be contrarian many a times. And in Q2 and Q3, what we noticed was that management, even though they had the firepower, decided to hold their firepower and not get into the best of the losers. So that is something that we would be observing. Because we do want to see management taking advantage of the firepower if they have it, right? And this management did not do that. However, we do like the fact that this management is conservative, and in financial services, we would rather have a conservative management than an aggressive management. Last is a regulatory risk, and the concern after the IL/FNS crisis was that RBI become much more stringent with NBFCs. We think that given the importance of NBFC in the credit ecosystem, we think that the risk is remote because NBFCs are actually doing the last mile funding and actually funding many of the underprivileged sections of the society. So we think any tightening will be very gradual. And since 6 months have passed, we haven't really seen any indication of RBI looking to tighten requirements around NBFC. So to summarize the thesis, first of all, financial services business, I think in India has a very long runway. Just to give you some facts, credits is very underpenetrated in India. So if you were to look at mortgage lending as an example, it's 12 to 13% of the GDP versus in developed markets between 70 to 80%. So we think there is a long runway in the credit space. We think there is a lot of opportunities in the financial investment space because financial investments are expected to provide better returns than physical assets like gold and real estate. And we think that Indians will become wealthy over time and will continue to do that at a fast pace. All of these areas JMF plays in, and they have good entities and good track record of growing in these areas. So we think JMF has multiple ways to benefit. We think that management can be trusted. Promoter owns 62% of the company. They have continuously shown the good capital allocation decisions, and some examples are raising capital at 162 a share in 2018 February when the markets were ebullient, and also having a very long horizon by investing in asset reconstruction and now seeing the benefit of it. So ARC, they have been investing since 2008, and now they are starting to see the value of that business. So they can think very long term, and they can make good capital allocation decisions because they are having such large ownership. We think the market is underpricing the company significantly. Intrinsic value is 132 a share, which is based on very conservative assumptions, and we currently have a price of 94 a share, that's giving us 40% upside on a current basis. And of course, here we have not accounted for too much of growth. We also think that this underpricing will correct within a year itself. And the reason is we think that NBFC business will pick up as liquidity concerns ease. As we have talked about, we think liquidity concerns have eased considerably in the last 6 months. And I think in the next 6 months, given the new RBI governor and given how things are moving, we think that liquidity concern will be a history. And as that happens, businesses will play, the NBFC business will pick up, and we think that will drive valuation here. The second business, the IWS business, we think is the earnings are depressed because there's nervousness in the capital markets. And the nervousness, as can be imagined, is because of the upcoming election, the national election that is going to happen. We think that national election, while it could impact some of the IPOs and all that in the short term, but the mergers and acquisitions and IPOs, there is a significant demand, and so that business will continue to do well. And lastly, the asset reconstruction business, we expect that business profitability will jump in the next few years as the resolution of the assets happen. And that profitability jump has not been accounted for. So combining all these things together, we think that, or we feel pretty confident that this 40% upside can be captured in the next 1 year. So with that, I will stop and see if there are any questions for me. Thank you.
Rajeev, thank you so much for such a clearly articulated thesis. Truly appreciate it. Perhaps you could just help those of us who'd like to track this idea over time. What would be the key data points to track to either validate or challenge your thesis?
Yeah, so I think the key business that is driving the valuation of this entity, I would say, are two. One is the NBFC business, the financial or the lending business. And so I think that is where we have to see how the competition is faring vis-a-vis what GMF is doing, as well as how the cost of funds are. So I think those are the two important data points there. What is the yield at which they're giving out the loans, and what is the cost at which they're borrowing? And then the second one I would say is the asset reconstruction business. And that is where I think the tracking would be about how the assets are getting resolved. As I mentioned, they have a very good resolution in Q4, where they had almost 3,500 to 4,000 crore of a distressed asset, which has been bought by Brookfield. So we will have to see how many of these assets get resolved, and therefore what sort of earnings come into the kitty of GMF Financial. So I would say those are the two main ones. And then there are some minor ones like the IWS business, which I would not worry as much about.
You talked about the fact that the discount to fair value might close over the next year. Is this the kind of stock where if the discount gets smaller, you would sell, or is this the kind of company that you might hold for several years?
Yeah, so actually that's a very interesting question, John, you bring up, because typically most of my ideas that I present have been multi-year ideas, while this one is not. And the reason for that is the management, as I've said, while we like that they're conservative, sometimes they tend to be ultra conservative, and therefore they miss the upside. So one of the things I will be monitoring is how are they looking at taking advantage of the opportunities that the market presents. I mean, clearly this is a highly unlevered company. They have high capital adequacy. But what I am looking for is, are they going to develop the conviction to lend when there is an opportunity and therefore capture the upside? And if I see that, then it is a multi-year hold. But if I don't see that, where they're going to be ultra conservative, and I understand because they have most of the wealth tied up, but then maybe the upside that we are talking about may not be as big, and therefore may not be a multi-year hold. So that really depends on what the management does over the next few quarters and how the business evolves is what I'm going to look at as I make that decision.
Okay, wonderful. Well, at this point, I would just encourage our members to feel free to follow up with you directly or to get in touch with us, and we'll be happy to facilitate an introduction. Thank you for showing your contact information here on the screen. And once again, Rajeev, always a pleasure to have you here. Those are some great ideas you've presented to our community, and we truly appreciate it. Thank you.
Thanks a lot, John. It's a pleasure.
Goodbye for now.